Hi, and welcome to Forex webinar number 5, where we're going to talk about technical analysis. For those of you who haven't seen my earlier webinars, my name is Jelle Peters. I'm the writer of Forex for Ambitious Beginners, which is available in the Amazon store, among other stores, as a paperback and also for the Kindle. I'm a writer for financial media, and I frequently give webinars and seminars like these. So in this webinar, we're going to look at technical analysis, what it is, how to use charts, what are technical indicators, and we're going to talk about some specific technical indicators just to give you a feel about how they operate. Obviously, there are many more technical indicators. I just picked a couple of the most popular ones. Okay, so the definition of technical analysis is that it studies past price developments in order to predict future price developments. Very basic. Now let's look at an example of how a past price development can help you predict future prices. This is a chart of gold, the price of gold between 2001 and 2011. As you can see, prices have moved up considerably, actually, from around $200 to $1,600 per troy ounce. Now there were consolidation periods in 2006 and between 2008 and 2009, but overall the prices have risen considerably. Now, if you were to make a decision in April 2011, whether or not to buy gold, then this chart could obviously help you make that decision. This should not be the only signal that you look at, but this is a sign that the price of gold is trending. So it's it's probable that the price of gold will continue to trend. Why would it stop trending the minute you'd buy it? Doesn't make any sense. And if you would have bought gold at that moment, you would have profited because the price surged to over $1,900. So you would have made a hefty profit. Since then, the price have retraced mostly or in part because the $2,000 seems a very heavy barrier. Price at the moment are around $1,770, so $1,770. So you would still be in the profit if you took a position here. Just to give you a little, insight into the price development there. Okay, so the importance of technical analysis has increased during the last 2 decades because more and more traders have started using it. You have to understand that in the past, like 20 years ago, technical analysis was used only by very few people because the amount of arithmetic that was used for it, the amount of computer memory that was necessary, wasn't available to everyone. And so it was a very specialist kind of job to use technical analysis, or you could do it manually. But nowadays, with the trading platforms that people use for Forex brokers, for other brokers, a lot of technical indicators are just standard tools of these platforms for free. So now a lot of traders are using them, which means that their importance actually increased because people act on technical indicators. So that it in some ways, in some instances, becomes a self-fulfilling prophecy as well. So yeah, you can't ignore it. That's for sure. Is it more important than fundamental analysis? I would say it's both. Both are important. You need technical analysis because it can tell you something about patterns in charts, about if the price development is as strong as it looks to be just from looking at a chart, stuff like that. But you need fundamental analysis to place it in a bigger picture. I mean, if the US economy is booming, if it turns out, to the surprise of many, that the non-payroll reports, as American job reports, show a surprising rise, and everybody starts to think that the economy is booming again, obviously that will have an effect on the prices, whether or not your technical indicators would show it. But they would, because people would act on that too. Both important. Now, technical analysis analysts use charts and technical indicators. Technical indicators are mathematical formulas that focus on a specific part of price development. For instance, the strength of a price move or how the average price is developing. By the way, next webinar we're going to look at charts and patterns. So there we're going to focus on charts. Here we're going to focus on technical indicators. This is a chart of the pound Swiss franc. Now the upper chart is the simple is a bar chart of the price development. The lower chart is a chart of the relative strength index, which is one of the indicators we're going to look at a little later. And the interesting part here is that the RSI looks at the number of closing prices, if they are higher or lower. So it kind of measures the strength of a development. Now what's interesting here is that if you look at the trend line that's been drawing here on the bar chart, the trend line here is actually down. It says, okay, we have a lower low, so there's considerable chance that we're gonna stay in the downtrend, right? But the RSI actually shows on the same in the same time frame shows a higher trend line. It's a climbing trend line. So what it says is we were in oversold territory, which I'll explain later, but we're now moving into neutral territory. So it's very likely, very probable that we're going to go in an upward trend. And as you can see on the chart here, the RSI is actually right, which is something you could have never seen on the chart itself. Okay, so there are three ways to look at price development. You can look at price development over time, which is the bar chart I just showed you. You know, it's just simple closing prices and see where we go. You could also look at the development of price development over time. That is the RSI, for instance. That looks at the development of price development. So it can say, look, there are more higher closes than there are lower closes. So actually the strength of this downtrend is declining because it's starting to reverse. That is a development of the price development. And you can look at price development in different time frames. Now that last thing is something that short traders should always do. You should always keep an eye on different time frames. Because if you are an intraday trader, for instance, and you're trading on 5-minute or 10-minute candlestick charts, and you don't know anything about the development that you could have seen in a 4-hour or a daily chart, you're missing out on some important signals. For instance, the most simple example I can give you, let's say that you are trading on a 10-minute chart, and you haven't looked at the 4-hour chart, and the 4-hour chart reveals a very strong resistance point that has been successfully defended in the past few weeks. Something you might not see on the 10-minute chart, because there, the period that you're looking at is much smaller, so you can't see how strong that resistance point actually is. For that reason alone, you should keep an eye on it to see how strong support and resistance points are. By the way, we're gonna talk about that in the next webinar as well. We're gonna talk about support and resistance in the next webinar. So technical indicators are mathematical formulas that focus on a specific part of price development, as we talked about earlier. For instance, strength of a price move or how our average price is developing. Now, there are several technical indicators. There are many of them. We're going to look at three. The first one is a very important one because it's used by many other technical indicators. It's called moving averages. The moving average is very simple. It's the sum of an X number of closing prices divided by 10. So for instance, you could say, okay, I take an X number of closing prices, let's say 10 closing prices, and then I add them up, and then I divide them by 10. So if you do that consistently, you get the average price over the last 10 periods. It's very handy. What it looks like, for instance, is this. Here you have a candlestick chart and you have 3 different periods of moving averages, 10, 20 and 50, and you can see that the current candlestick chart is trending considerably above the 50 period moving average. What that means? It means that if you look at the average closing price of the past 50 periods, then the current price is considerably above that. So it's trending above average. Now obviously the smaller the moving average period is, the more recent the prognosis. If you're trending, if the price is trending above the 10 period SMA, it's a little bit more significant because it means that right now the price is higher even than if you look at just 10 periods ago, the average price there. Okay, so the problem with the simple moving average is kind of what I just said, is the lag. The longer the period, the more periods you use, the more the current price is behind on the reality of the moment. Now, one of the solutions is the exponential moving average. What is that? That gives more weight to the current price than to prices of 10, 20, 30 periods ago. So if you then have a 10 period EMA, exponential moving average, you would say, okay, I'm gonna give, I'm multiplying the last, the most recent closing price by 10, but the closing price of 10 periods ago, I'm gonna multiply by 1. So obviously then it has less significance. Now the way you use moving averages, or that you could use them at least in a significant way, is by looking at crossover systems. What you then do is you look at, for instance, when the shorter term moving average crosses the longer term moving average from above, then it generates a sell signal, because it says that in the shorter period ago, shorter average is now starting to trend below the longer period moving average, which means that apparently prices are rapidly declining. Now, Bollinger Bands are very popular. There are scores of books written about them. They measure the standard deviation of a price development against the moving average. So, for instance, here you can see that if the middle line is the moving average and the two outer lines are the standard deviation lines, it tells you whether or not the price is trending abnormally away from the moving average. Because it creates kind of a bandwidth, because obviously if it's just a short difference, a small difference, doesn't really matter. But if it starts to become a big difference, then you have the signal. Little quiz: when do you think Bollinger Bands are close together? What is price development doing? Is it volatile, calm, or impossible to say? Just take a moment. That's correct. Then the price development is likely to be calm. Now, Bollinger Bands are used both in range trading and trend trading, but they're a little less useful in range trading because touching the band alone doesn't generate a buy or sell signal. What it does tell you, by the way, for a range trader, is that it tells you that if the market is calm, it can tell you that it's a good climate for range trading because you're looking for calm markets. But for trend trading, it can actually help you stay in the trend longer and generate an exit signal for you. So that's more useful. Now, the relative strength index, we talked about that earlier, measures the relative strength of a trending movement. So what it does, it says, okay, I'm going to count the number of lower closing prices and the number of higher closing prices, and based on that, I can tell you something about the strength of a trend. Now, the result is a number between 0 and 100, and above 70 signals overbought and below 30 signals oversold. A picture of it here. As we talked about earlier, the most significant way to use it is to look at divergent points. So where the RSI, for instance, moves from an oversold territory into a neutral territory, or the other way around, from overbought to neutral territory, and it shows that the trend line is different from the trend line on the normal chart. There, it's going to be interesting and generating a sell, respectively, or a buy signal. One word of warning: don't assume that when the price starts moving into oversold or overbought territory, that alone is enough for you to take a position, because prices can stay in overbought, oversold territory for a long period of time. Okay, so next webinar, we're going to look at charts and patterns. It's going to be very exciting. We're going to look at support and resistance, at chart patterns, head and shoulders, double bottom, double top, stuff like that. It's going to be interesting. You're going to see some patterns that you could right away trade off if you find them in your own financial instruments. So see you next time on this next webinar. For now, this is the end of this webinar. Thank you very much for watching.